Today we will be discussing the investment prospects for convertible bonds. My guest is an expert in this asset class, Skander Chabbi. Good afternoon, Skander.
Good afternoon.
When you typically hear about some outflows from the high yield market, we've been hearing some stories about that recently, is that a time that you're rubbing your hands and you're thinking, well, this is our time, the money's going to come into convertibles now?
Well, the money has been flowing in to the convertible asset class. We've seen strong demand for the convertible bond product. That has been on the back of, first of all, the great rotation theme, which has not totally materialized, but nevertheless there has been some interest from investors to increase their exposure to hybrid-like structures. Second is, of course, with the developments in the high yield market or just generally in the corporate market, where some investors might feel tempted to take some profit here after very strong few years of returns. Convertibles offer a decent alternative. Of course, not in the same size. The market is limited compared to the high yield market, but gives nevertheless some exposure to the equity market.
But a cynic might say that that is a sign that the manager, the asset manager or the wealth manager is showing a lack of conviction, that they're not prepared to really put their name behind buying a straight bond or an equity and go all the way.
I think it's the convertible bond market is a bit more technical than some other products. So picking individual convertibles would be a little bit more difficult than just picking individual bonds or individual equities. So it makes more sense in that respect to pick a fund or a product that meets that kind of balanced exposure to the asset class. On the other hand, you can also play the convertible market for all the bells and whistles that are built into the product. We mentioned a bond with an embedded call option, but there are also other factors that push or drive the valuation of the convertible bond. One of them is the takeover protection that investors can benefit from in the convertible bond product. So typically in this environment where companies are looking for growth, convertible issuers have been many times targets from larger companies. And so a way of playing this M&A theme is by buying into the convertible market and getting exposure to the convertible bond product. So it's not for lack of conviction, it's because of maybe of the technical aspects of convertibles, and because of that natural ability to move back into low sensitivity when markets tumble and to capture the upside when markets rise, that convertibles make sense today to hold in a balanced or fixed income portfolio.
And can you give me some examples of some of the popular issues in the market?
Yes. We've seen in the US notable issuers such as Tesla Motors, which has issued a convertible this year for pretty large size and has used the convertible market the year before as an attractive financing opportunity because they get lower yield, as we highlighted, for a chance providing a chance to investors to participate in the equity story. So they've raised north of $1 billion in convertible bonds, so that has been a popular story. In Europe, we've seen quite a different story. A lot of peripheral corporates that have used the convertible market as a cheap way to refinance as well. If you look at the cost of financing that they've attained, they've reached on convertible bonds compared to the cost of financing on equivalent straight debt, they shaved off maybe 40–50% of cost of financing by issuing convertibles. And they've also provided investors with a chance to participate in the equity story, of course, and in peripheral markets that have behaved quite strongly up at least until the beginning of the year. It's been a nice story to be exposed to some of these convertibles. We've also seen a few large exchangeable convertibles. These are a little bit different than your standard convertible, but they offer investors the chance to get exposure to a credit, a straight bond, with an embedded option or equity option to another company. And these structures have been quite popular for companies that are trying to offload cross holdings that they might have across the different their corporate environment.